everyone. Thanks for joining us today. My name is Joe Schwartz. I'm a partner at Sidley Austin. Joining me today, my fellow panelists, Stephen Prince, CEO of Tetragon, Brad Pilcher, partner at Bonaccord, Michael O'Keefe, Chief of Staff at CAS Investments, and Joel Levin, CIO of LCA Capital. I always think it's important, especially at GP stakes, just to start off with a couple minutes of some basic education. I was thinking maybe, Brad, you can kick us off with just a couple minutes. What is a GP stake? What is it when people buy and sell a GP stake?
Yeah, it's a great question, and one I love answering, because I think there are a lot of misperceptions about the strategy and what it is. I think oftentimes when people look at GP stakes or even just listen to the name, they think it's something very exotic and very strange. But the truth is, we're simply a growth capital strategy focused on investing in private markets firms. And so there's some specific elements of kind of what drives our return profile or exposure to fee-related earnings and carried interest and GP investment income. But at the end of the day, what we're really doing is finding great companies who have tremendous growth opportunities. We're providing them with capital, we're providing them with operating expertise, and we're trying to help them to achieve their business plan.
Fascinating. Stephen, does GP stake mean the same thing to you, or does it mean something slightly different? Or
So for the most part, it means exactly what you elucidated, Brad. But there's one aspect of Tetragon that's slightly different than others in the GP stakes arena. For the most part, Tetragon is looking to gain exposure to various alternative asset classes as an LP with our balance sheet. And we find it quite attractive to take our balance sheet capital and marry that with an ownership stake in the manager. And so for us, for the most part, not in every investment we've ever made, but for the most part, we're looking and saying we really like biotech, or we really like legal assets, or things like that. And then we say, is there something we could buy, build, or seed, and therefore put in LP capital and GP capital?
Thank you, Stephen. So one thing, that a lot of the rage in the asset management M&A space of late, and for quite some time now, has been consolidation, right? There's the market out there is tough, it's turbulent waters, and a lot of the smaller shops are finding that the overhead and the expense to run firms is punishing. So we see a lot of control deals happening and a lot of consolidation in the space. Whereas GP stakes, traditionally, or not always, are usually referring to owning a minority interest in a fund sponsor or asset manager. I'd like to spend a few minutes to discuss thoughts around consolidation. What does that mean for the GP stakes space and the GP stakes fund sponsors? Michael, why don't you take us?
Yeah, happy to. I think consolidation itself is a byproduct of the broader theme, which is growth of private assets, right? A tremendous amount of money is flowing here. Building on what Brad mentioned earlier, the whole concept of a GP stake provides extremely unique exposure to the underlying assets. Why would any investor on the planet, whether it's a control buyer or a minority investor, want to own a GP stake? You have incredibly stable, contractually obligated management fees. You have bond-like risk or downside protection with significant exposure to upside optionality. You have basically no correlation to broader markets themselves, and you're getting broad-based exposure to alternatives in general. And so when you offer that kind of an asset to any kind of very large institutional buyer, whether that's an asset manager or not, it becomes irrefutable or incredibly attractive, which is why so much consolidation is taking place. You see HPS's sale to BlackRock, you've got Monroe's sale to Wendell. I mean, the list goes on and on and on. And it's a byproduct of incredibly attractive characteristics that cannot be replicated by really any other subsegment of the market. And I think what's also interesting here is we're seeing the maturing of an asset class that really hasn't been around that long. And we're entering a phase in the market where, a decade ago, one of the key questions for folks who were pioneering this was, hey, this is a totally illiquid asset class, how do I get out? And consolidation is one potential path that's becoming more popular, where stakes that are owned by folks like Brad or really anyone up here can get sold to bigger managers, and helps facilitate the general cycle of a GP, right? Small manager is successful, becomes medium-sized, finds their way to Brad. Brad helps them become significantly better. They find their way to Michael Reese or the Blackstone team or anyone else, or they sell to a larger buyer. And so it's just facilitating the life cycle of an asset manager.
Joel, you've been in since early innings in the GP stakes. Have you found the trend of consolidation and asset management to really change the way you think about think about these portfolios? And have you, aside from whether it may change how you think about them, have you noticed any actual trend in the way these the timing of exits, or whether consolidation is limiting the supply in terms for minority interests?
I gotcha. As an investor in GP stakes going back about a decade at the family office where I work, I'm very positive about the consolidation in the space. I think when I think of my underlying GPs, I want them to take every path or every avenue that's going to provide them the best business outcome. And if it's a middle market buyout manager who has one strategy, is going to bring on a private credit platform or hire a real estate team or build out secondaries interests, I think that provides multiple exits for them. They become much more attractive to existing LPs, but also to future LPs as they become the one-stop shop or the one place they can go, the full suite of alternative options for their LP base. I think there is some pushback that maybe they're getting too big, but I think you should look at the flip side, which is the stronger getting stronger. And as you get bigger, you have more resources, you have more operational efficiencies, you have better ways to build out the platform, from capital formation to business development. I think that is a real benefit when it comes to consolidation. I think there's still a place for the smaller, nichier managers who want to go at their single strategy. But when you think about consolidation and bring it all together as an LP who's investing in GPs that want the best opportunity set and the best revenue stream that flows down to an investor in the GP space, I'm very positive on it.
Thank you.
One minor comment that I think is actually really important. Too many people silo GP stakes into its own world and never draw comparisons to the broader market. One that came up maybe as a byproduct of your comment, when you look at startups in general or fast-growing small to medium-sized companies, the idea that a Google or a Microsoft or someone like that could come along and acquire them is extremely positive, right? They view it as their maybe primary path towards monetizing the success that they've built. And so when, if you look at consolidation itself as a trend and you're a small to medium-sized asset manager, this should be viewed incredibly positively. If you do your job well and build an attractive asset that is then desired by a BlackRock or a Blackstone or anyone on that list, that's incredibly successful for you. It's successful for those who own pieces of your GP. It's successful for everyone around you. It's very positive.
Yeah, if I could just add to that, I think, it's a topic people talk about a lot, but to really get specific, the questions I'd ask is, what's happening from a consolidation perspective? Why is it happening? And then what really does it mean for us as GP stakes investors? And I'll start with the why, because I think there are two concurrent themes that are coming together. Number one is from an LP perspective, and I think this is true for institutional LPs and all sorts of other ones as well. A lot of LPs want to commit more to private markets and do it with a smaller number of sponsors. So what that means is that sponsors who want to maintain those good institutional relationships need not only to be able to deliver exceptional returns, but they need to be able to do more and different things with the LPs that they have. So that's kind of driver number one. Driver number two is, when you reach a certain scale, it becomes very challenging to grow a product. As we look across the landscape, I think we see about 15 different private equity fund series that have achieved mega cap status. Think of fund size of 15 billion or more. The average fund over fund growth of those mega cap fund series after they've reached that status is about 5 to 6% from the prior fund to the next one. If you look at broader private equity fund over fund growth over an equivalent period of time, it's been closer to 50%. So when you reach a certain size, the growth rate of your fund series begins to tail out, and so you need to search other avenues for growth. Now, there are plenty of great organic opportunities for growth, but a lot of larger firms who have public currency that is very valuable see an opportunity not just to add capabilities, but to add earnings in a way that can be really accretive given where their shares trade. So those are two key drivers that we see: the demand for LPs to do more with a fewer number of sponsors, demand for large firms to find other avenues for growth. Now, what's actually been happening? If you look at 2021, 2022, and 2023, by our measurement of publicly announced M&A deals in private markets, acquiring control of a private markets business, all 3 of those years were effectively record years. You had between 25 and 30 noteworthy acquisitions of private markets businesses, close to double the pace we saw before those 3 years. So what happened after that? It grew from 25 or 30 per year over those 3 years to in 2024, there were more than 50 acquisitions of private markets businesses. $300 billion per year of AUM was acquired in those first 3 years. $500 billion was acquired in 2024. But what's interesting when you really drill into the data is not just the prevalence, the number of deals, the magnitude of AUM acquired, but it's also the types of firms that are acquired. Because you read in the news about a GIP or an HPS or these mega deals that are pretty cool. But if you look at the median size of an acquisition target in a controlled deal in private markets over that period of time, it's just a little bit more than $5 billion in assets under management. So that's really interesting. That's a little bit contrary to what you see from the theme. And obviously for us, as a mid-market GP stakes investor, that's a really important point as we look to potential future exit opportunities. The last other thing I'd add to kind of what do we do about it is I think it speaks to the importance as a minority partner in a private markets business of helping them to develop their toolkit. And this is a lot of why we see firms wanting to do deals and how we partner with them after they do a deal. It's really figuring out how to go from being kind of a boutique investment business into becoming really a private markets platform who can do many things for many different types of investors. So that's a critical area of where we focus.
And all 3 of you mentioned consolidation in the context of exits. So you can't have a GP stakes panel unless that doesn't discuss liquidity, right? It's always, and whether it's been answered, it doesn't really matter. Liquidity was and probably still is an important consideration for limited partners when they're thinking about investing in a GP stakes fund. Probably a little bit of a different analysis for you, Stephen, when it's a balance sheet type approach. But I'd like to discuss a little bit what's kind of the latest and greatest in terms of liquidity. What are we seeing in the market? How are GPs getting creative to generate distributions and liquidity on the portfolio and for the limited partners? Michael, why don't you kick us off?
Yeah, happy to. I'll start. Everyone in this room should recognize part of what's so beautiful about these stakes is the amount of cash flow that you get from them, not only contractually obligated, but maybe opportunistically earned. And that is a way that this will naturally occur, right? Liquidity will find its way to you through that cash flow. Setting that aside, there are traditional tools like securitizations that have been around for a while that are incredibly popular here. They're major wins for every party involved. Investors themselves receive cash early. They accelerate IRR. Managers get to show DPI. The lenders, I mean, it's a no-brainer asset in every way, shape, or form. What we're seeing over the last maybe couple of years develop significantly more that has been more prevalent now than less prevalent are probably strip sales in general, right? Blue Owl went through a strip sale last year. There are a few potentially that may occur in the near term here, but that is maybe a byproduct of the consolidation theme where I would just go back and say, why would someone want to acquire a basket of private asset managers? It's incredibly attractive for the same reasons that we stated 5 or 10 minutes ago. You cannot replicate these assets anywhere. And when you start looking at the paths towards generating that kind of cash flow stream, there are folks who will build it organically, and there are folks who will choose to acquire it in bulk or by single asset manager. In a strip sale, the ones that have been completed, I think, are extremely crucial signals to the market that there are not only those that are willing to sell to generate liquidity, but there are those who are very willing to buy because you cannot replicate this asset stream anywhere else. So there are willing buyers and sellers on both sides. That's incredibly important to note. The other one that we'll note is we use the term GP stake, I think, a little bit too constrictive. Really, it should be thought of as GP growth capital. It's a manner in which you help an asset manager grow or accelerate its own development. And so buying an equity stake, whether that's a minority or a control stake, is one way to do that. But there are other mechanisms that we're seeing in the marketplace that fit more in structured financing solutions that are not true equity stakes, but are yielding cash flows as a byproduct of exposure, shall we say, to the underlying GPs themselves. And so In those transactions, oftentimes there are quite literally terms baked in where liquidity is being generated just by the structure, or asset managers themselves are incredibly incentivized to get cash in part or in full back to the investors as quickly as humanly possible because it's in their interest to do so. So we're seeing a lot of creative structures that encourage the return of capital significantly more fast than maybe a traditional stake would warrant in a vacuum.
Stephen, I'm guessing you probably have a slightly different take given just the different structure of the way Tetragon invests in these.
Yeah, so Tetragon, for those that don't know, is a publicly listed fund. So that gives us the privilege of having permanent capital, shareholders' equity. And so generally, I think we're somewhat different than other funds that are organized to buy GP stakes. There's two things that permanent capital allows us to do. The first is the deals that we're able to do on the outset, we're able to have a very, very long time horizon when we first do the deal. What that means is in year 1, 2, 3, 4, 5, we might not have any cash returned to us at all as we're trying to build a business. The second thing is we can be agnostic about when and if we're ever going to exit any of the assets that we own. And for us, exiting assets is really more about is there a partner or partners that we can bring into the capital structure to accelerate an already successful business of ours. It's not really about DPI or returning cash to our shareholders or anything like that. It's more about improving the asset that we already own.
And I'd say, there are a lot of different ways to own GP stakes, and there are some people who have a permanent perspective, there's some people who have a long-term perspective, and some people just like a 10-year fund life. What I would say is, I think it's the single biggest misperception in all of private markets that GP stakes is a fundamentally illiquid asset class. It's just not true. It's just not what we've seen in terms of the experience of real life. Now, what is true is GP stakes, especially in the private market space, is a young strategy. Right? I mean, the first vintage, I think, with a full focus on private markets was 2015. So the oldest private markets GP stake portfolios are 10 years old now. So we're just getting to the point where we'd expect to see things. But people often ask us, why would you invest in GP stakes? Nobody's ever realized those. How many portfolios of GP stakes do you think have had a realization event? There's 6. Most people think it's 0. And the forms of those realizations have been diverse. We've had strategic sales to multiple different people. We've had strategic mergers. We've had public listings of private funds. When I say we, I mean the market. We're too young to have done any of these yet. Now we've seen, to Michael's point, partial realizations. And so there have been a tremendous number of events in addition to 10 securitizations, in addition to 10 single investment realization events across IPOs and control sales and partial sales of GP stakes. So the reality is that the hit rate for liquidity in GP stakes is phenomenally high. It's just the sample size as of today is small. But that is all going to begin to change. And it will change even faster because of the magnitude of capital that's flowing into the strategy. We're at a point now where we have a really vibrant ecosystem of all types of different GP stake investors. Large, medium, small, seed, permanent, preferred, strategic and financial buyers. And the best analogy I could think of is what we've seen in the secondary space, where if you go back in time 15 years, secondaries is probably a very vanilla business. But the more and more capital's flown into it, the more different types of transaction you see, from primary secondaries to GP-led to continuation vehicles to preferred financings. And we see GP stakes very much following the same type of trajectory. And so let's come back and all sit on this panel in 5 years, and that 6 portfolio deals will be 10 or more, and the 10 securitizations will probably be 20, and the 10 single stake liquidity events will be something far higher than that. So it's a phenomenally favorable time to be getting invested in the strategy.
Yeah, for sure. And we're even seeing the strategy creep back into hedge a little bit, right? With the AMG Verition deal and some other hedge fund managers that are reportedly discussing or wanting to sell a stake in the firm. Let's pivot a little bit. I want to focus on kind of the market downturn, the difficulty in fundraising in private markets, and what that may or may not mean for stakes. Joel, why don't you help us understand a little bit, in discussing with your GP stake managers, what are they saying about the difficulties in fundraising, the slowdown in realizations, and regardless of what they're saying, are there any noticeable trends in the portfolio?
So I have not heard of any issues of hitting their targets. They've been able to fundraise successfully, but the period has been elongated. So typically they were hoping for a one and done or maybe 2-3 closes. Now it's 4 or 5, and it's being extended out with the GP advisory consent. It may be taking up to 2 years now to get that full allocation that hit their hard target. But I think from an LP perspective, I can tell you that when dividends or distributions have really slowed from my other strategies, whether it's buyout, VC, growth equity, GP stakes has been an incredible way to generate income for the portfolio. I mean, from firsthand experience, we've never been more out of pocket than 55 or maybe 60 cents on the dollar. And you think of that, it's a very efficient way of capital deployment. And when distributions are slowing elsewhere, but the distributions continue to come in from the GP stakes, the way I positioned it to my principals early on was view this as a semi-perpetual bond that when it's fully ramped up is paying a very high cash coupon, somewhere in the mid to high teens, that benefits by the appreciation of the NAV of the underlying assets. That's a bond I never want to sell. I never even need a realization. I'll just continue to clip a coupon if it has a gross yield of 15 to 18%. I can't think of a better bond that has really, when you think of it, limited duration exposure. Yes, it's a long-dated bond, but you're not subject to interest rate movements except if you're using a credit line. So in general, this is a very attractive asset class in terms of the cash flow, especially when you're not getting those cash flows from the IPO market that would come for VCs or growth exits and middle market buyout transactions. It's been a slowdown in natural buyers. So I think even though there's been this natural slowdown of distributions elsewhere, GP stakes, it continues to be quite strong.
Michael, Kaz, you guys have a broad view of the market. Brad mentioned the different segments of the market. Interested if you're noticing any trends, or any differentiation among those different stages, whether it's almost the seed stage or middle market or upper middle or mega or not.
From an asset raising standpoint or from an allocation standpoint?
Asset raising.
Yeah, I think I was actually thinking about this while the question was asked. We started this panel talking about consolidation, which is really like the bigger getting bigger. And the way that I might amend that in this context is it feels to me more like the best are getting bigger, right? It's not just the largest asset managers in the world that feel relatively immune to the broader fundraising challenges, but it's the highest quality managers in every respective pocket of the market. They're the ones that don't really feel the brunt of this. If you're, Joe's garage band, private equity firm, subsection B, and no one knows who you are, maybe in 2020 and 2021, you've got a shot to go raise money. Someone's willing to place a bet on you. But if someone's, if they're under the gun and they have to make a choice and you can only allocate to one manager and you're gonna do it in healthcare, go allocate to Revelstoke. Don't allocate to some random no-name whatever, or pick your name out of the hat. Choose the absolute highest quality manager, and that's the consistent theme that we're seeing. It's not just the largest, it's the best. And so, we happen to be very fortunate. We own a tremendous number of stakes in what we would consider to be the highest quality managers in their respective subsegments. Every sector, every asset class, every large, medium, small, and across the board, we haven't really seen the same kind of challenges in those underlying managers that are reported on a broad basis. And it's a byproduct of being very intentional on the managers you choose on the front end and having the right partners to make sure that those managers are chosen.
What I'd add to that is something that we often have to answer the question about, since we specifically invest in the mid-market, is kind of that point, what's happening to mid-market firms? And I couldn't agree more with Michael's point that it's really a flight to quality, irrespective of size. But this is another area where there's some real misperceptions. If you looked at mid-market PE firms' share of private equity fundraising in 2021, the equity bull market, it was 36%. Right? And then we hear over the subsequent periods, since fundraising has gotten tough, that all the money's going to the big guys. Well, the big guys are getting bigger, but everybody who's good is getting bigger. So that 36% market share at the end of 2021, by the end of 24, had not declined. It grew from 36% to 44%. So in a tough fundraising environment, mid-market firms actually took more market share. And as we look forward to areas of focus for institutional LPs today, the top 3 areas of focus are small and mid-market buyout. So it's just an area that's a little bit counter to the narrative that you hear in the broader market.
Yeah. All right. Let's get one final question in, and then we can close. McKinsey recently, in their private markets report, I think they noted that of the LPs that they polled, roughly 50% of them have an allocation to GP stakes, and of those LPs, roughly 50% of them had said that they've come to learn the attractiveness of the asset class over the past 10 years, as you've heard today, and they are actually thinking about getting some direct exposure and maybe buying stakes directly from the managers, which, Stephen, you can probably talk about. I'm interested to kind of get, Stephen, your view, but first maybe Joel's view. Maybe you're an LP in the space. Have you considered just going direct, or do you think continuing the path of investing in the GP stakes funds and the professionals that are really good at this is the better path to go?
So we've looked at some direct deals, primarily that come as co-investments from our GP stakes managers. I think it's a different skill set to go out and underwrite, source, underwrite, and due diligence a direct stake in a GP. I think what you're going to see, and we've seen examples of this already, where larger pools of capital, whether it's a sovereign wealth fund or a pension, will partner with some of the best GP stakes managers, a few on this panel, to guide them as they're looking for direct stakes. And I think you'd want that team who has an expertise, who's been doing this for a decade or longer, about identifying the best GPs and helping them build the business. If you're a GP, you're going to want someone who brings more to the table than just capital. You want someone who brings strategic advice, someone who can help build the business, that can share best practices from other GPs in their portfolio. I think trying to identify them on your own is fantastic, but at the end of the day, I think that GP is going to want a larger organization that brings more to the table than just capital from one individual.
Yeah, Stephen, I think this is, in essence, a core element of the Tetragon business. Why is it that you would look, in addition to the LP capital, taking a stake of the GP and the manager itself?
So we have a global operating platform of distribution, legal, compliance, operations, systems development, et cetera, and a track record longer than 10 years, probably about, 17 years of buying, building, seeding asset managers. So it's something that we think we're quite good at. You know, when people that manage money are not necessarily great at building asset management firms, the skills might rhyme, but they're not, perfectly the same. And so what we found since about 2008, 2009 is we're pretty good investors, and we think we're very good business builders within the asset management space. And so marrying those capabilities, both being an investor of capital direct and as an LP, and being able to partner with some of the best asset managers in the world and helping them build businesses that perhaps they wouldn't have been able to build as big or as quickly on their own, we think is a very powerful model for our shareholders.
All right, we got about a minute left here. Why don't we take 15 seconds each? I want to hear your favorite part about being in the GP stakes in the asset management M&A space. Why don't, Joel, you kick us off.
I'll lead off. Cash is king in this environment.
I can't say it much better than that. There's no asset class on the planet that can replicate every single one of the attributes that this has. GP stakes brings them all together. It's the best part of bonds, cash flow, low risk. It's the best part of growth, upside optionality. It's the best part of secondaries, basically no J-curve whatsoever. You find another asset class and we'll have a conversation, but
I don't think I can. All right, Brett.
Working with great entrepreneurs and great investors and helping them all to win. It's just fun.
Yeah, Steven?
Yeah, I would say, we're an investment-centric firm. We do direct investing, LP investing, so at the end of the day, being investors, investment-centric, to be able to partner with great investors and build something with them is really rewarding.
And my favorite part in the industry is helping all these guys achieve all those great things that they just said. All right, thank you everyone for joining.